Creamer Media's Mining Weekly Online is talking to Mbazima, the outgoing CEO of Kumba Iron Ore. There are several projects which you want to accelerate, which seem to have attractive potential returns. Can you outline them for us, please?
Ultra high dense media separation. We've been working on this for years, and now we have cracked the technology. What you see now is the deployment of that technology. So we've got a modular plant at Sishen right now. It's already commissioned. It's working very well. It's producing between 2,000 and 3,000 tons a month. So we're going to build another one next to it, treating the same material. And then we're going to build another one in Kolomela. That's already being built. It's now in commissioning. And next year it will produce 0.7 million tons for us. And using that same technology, we are going to retrofit the current DMS plant and make it a UHDMS plant. And that will provide us with another about 3 million tons of production from material that has already been mined in the past. So this is material that does not attract any mining cost. And the retrofitting will be quite cheap by project standards.
And what is the capital cost and what is the expected return?
We are in studies right now, so we are unable to give definitive figures about that. All I can say is that there are mouth-watering financial metrics associated with these projects. That's why we are accelerating them.
And you spoke about financial instruments and you gave a few details. Are you hedging?
No, we're not. Hedging requires you to guess what the price is going to be and then try and beat the market by doing so. We're not doing that. What we want to do is to make sure that we always get the floating price at about the time of discharge of the ship. So once we know that, then we can structure our agreements with customers to make sure we achieve that. So there might be a customer who says, I want a fixed price of X. We will give him that price and then go and do the financial instrument to ensure we get the policy price that I've just talked about.
And on the horizon, there's a lot more supply coming through. Is the big downward push on prices still to come?
Martin, what we did see before was increases of 8 or 10% per annum in supply. I think we are over that particular hump. But that doesn't mean that we're going to see no increases. We're going to see some increases in supply. And the projects we are talking about, Roy Hill, Minas Rio, and S11D will all add to the supply. And at the same time, we've seen the higher cost suppliers getting out of the market over time. So we're seeing a slightly better market than before. It's not yet in balance. It will take some time to get it into balance. And therefore, in the short term, we're going to see pressure on prices.
And the analyst sitting next to me started showing me a whole lot of figures and doing a few calculations. And he says, look at these guys. Their transport cost is very high.
Clearly, as the other costs have been coming down, the logistics costs have become a bigger percentage of our costs. We do have the disadvantage that we are 900 kilometers away from the sea, and we are more than twice as far away from China as we would be if we were in Australia. However, per ton kilometer basis, our logistics expenses are quite competitive, but clearly the kilometers are more, and therefore in total terms we pay more for our logistics.
That was Creamer Media's Mining Weekly Online talking to Mbazima,